Hello, everyone. Welcome back to another edition of the Weekend Charts. I'm your host, Charlie Bilello. A lot to talk about today. If you're watching this on YouTube, hit that subscribe button, hit that like button for more content just like it. So, what are we going to be discussing today? Of course, we have to talk about the jobs report. We're slowly closing what I call the jobs gap. The end of an uptrend, NASDAQ 100 closing below its 50-day moving average. First time in a while we've seen that. A little bit of trouble at Tesla. We'll talk about new delivery data, why you should expect higher volatility going forward. I'll talk about that. The most expensive short in history, and that being likely Trump media. I'll just dig into that. Very interesting stats there. How to lose $1 trillion, a little bit of a lesson from the Fed on how to do that. And June in Jeopardy, well, that's talking about the Fed rate cut. It's becoming less and less likely, it seems like every single day, that the Fed will be able to cut rates in June. Is CPI understating food inflation? A lot of people have been saying that to me over the past year, and it seems like, according to a recent analysis done by the Wall Street Journal, that seems to be the case. And we'll end, as we always do, with something positive, and that's a new all-time high in household net worth. So let's start out with that jobs report, closing the jobs gap. What did we see in the month of March? Well, we saw another month of growth in terms of jobs. Now, 39 consecutive months of payroll growth, 303 jobs added in March versus 200,000 that were expected. So blowing out expectations. Where did the jobs come from? These three areas will likely sound familiar because they've been the top three most of the time over the past year. Number one being healthcare, 81,000 jobs added there. And this is a secular trend likely to continue. People in America getting older, baby boomers getting older, using more healthcare services, and we simply need more workers. We need more nurses. We need more doctors. We need every type of job in the medical field is really in demand. So this is going to likely be one of the top categories for years to come. Number two, government, and we're seeing this more often. 71,000 jobs last month. Leisure and hospitality being number three. And there was a big shortage in this area, and that was causing a lot of problems for businesses. So this is a good sign. Workers are coming back. Leisure and hospitality space, 49,000 jobs added there. What happened in terms of the unemployment rate? It actually ticked down a little bit from 3.9% down to 3.8%. And so still very, very low here. So we have a historical average of 5.7% if we go back to 1948. So still well below that historical average. And it's not just a low rate that's kind of unusual here. It's the fact that the low rate has persisted for so long. So if we're looking at streaks, consecutive months below 4% for the US unemployment rate, 26 consecutive months now, you have to go back to the late 1960s to find a longer streak than today. So very long period of low unemployment, very unusual historically. And there's no real sign that this is going to spike higher anytime soon. So perhaps we're going to surpass this period from the late 1960s in the coming months. So average hourly earnings, this was expected, but still another strong number in terms of wages, going up 4.1% over the last year. Fed is obviously looking at this number closely with the idea saying, well, the labor market is loosening. That's a good sign, but there's still wage pressures here in terms of inflation. A lot of different thoughts there, but unlikely you're going to see a big move lower, let's say a quick move down to 2% inflation when you have wage inflation still above 4%. So 33 consecutive months now above 4% in terms of wages. And of course, as long as that's higher than inflation, that's a good thing. And it seems like that will continue to be the case. Next week, we get a CPI report. The expectation is that it will come in at 3.4% for the month of March. So good sign there that we're still above the rate of inflation. Hopefully that continues to be the case. So what do I mean by closing the jobs gap? Here's a visual here. The blue line would be, let's say COVID never happened and job growth continued at 1.5% per year. So we added 1.5% new jobs every single year. We would be at 162 million total jobs in America today. Where are we instead? We're at 158.1 million. So still a 3.9 million gap. Of course, the gap was enormous initially following COVID. We were slowly closing that gap, but it's still there. And I think this is one of the biggest drivers of continued strength in the labor market, the fact that there's still more demand for labor than supply. And I think that's reflected here in the number of job openings staying elevated, 8.8 million versus 6.4 million unemployed. So still 2.4 million more job openings than unemployed. And that suggests likely to continue to see labor market gains in the months to come. So what's the primary driver of this big gap here? Why hasn't this been closed? My view, this was one of the primary reasons of the fact that people retired early starting in late 2020. It's continued really today. This is data as of the end of the fourth quarter last year. And I suspect if we had updated data, that it would show something similar for the first quarter in terms of this trend continuing. People simply retired earlier and they're not coming back into the labor market. So if you look at the labor force participation rate for older Americans, let's say 60 and older, well, that's really dropped and hasn't recovered. So while younger workers have come back into the labor force, looking for work again, getting jobs again, these older early retirees don't seem to be coming back. And the big driver of that seems to be the fact that their net worth simply surged higher during the past few years. So they have the ability to retire sooner. So as long as this gap persists, you're likely to see it take more time for the labor market to normalize. It's definitely loosening every single month, but we're still not back to normal, I would say, just yet. So whether you're retired, you're still working, any stage of life, at Creative Planning, we're here to help. We're in all 50 states, so wherever you are, we likely have a location nearby. Reach out to us to schedule a call or a meeting. You can go to creativeplanning.com/Charlie to get more information, schedule a call or a meeting. We're here to help. Number two, we got to talk about the end of an uptrend here. Huge uptrend in the NASDAQ 100. We have the NASDAQ 100 index above its 50-day moving average for over 5 months, and that streak ended this week. So we saw the first close below the 50-day moving average since November 2nd, 2023. Very unusual to see. You see the light blue line here, the rise here staying above that 50-day for this long. Not typical to see this smooth ride higher. We actually ran up 20% since that first close above the 50-day until the end of the streak. So 153 days in terms of duration here. That was the 8th longest streak above the 50-day moving average for the NASDAQ 100 in history. We have data going back to 1986. So the question, of course, well, this streak has come to an end. What does that mean? Does it mean the market's going to crash? What's going to happen from here? We don't know. There's so many different possibilities. You could have a situation like 1995 where that was just a little pullback and then the market continued to run for the next few years, then ultimately peak until 2000, and the rest of 1995 was very strong. 2017, we saw something similar. Back half of 2017, very strong as well. So just a little interruption. Of course, 2018 was a more difficult year, but a little interruption there. If you look at 2011, we had a 20% correction that summer, a very quick 20% correction. So I think the point being every time is different. When I tweeted this out, a lot of people were pointing out this number right here saying, oh, is this March 2000 again? Of course, anything is possible, but that would be, of course, the worst case scenario where the NASDAQ 100 would go on to decline over 80% following the dot-com bubble. But you can see the situation we're in today, not exactly comparable because the run-up preceding that was just unbelievable, parabolic 78% advance preceding that peak in the NASDAQ in 2000. So huge uptrend, but a much bigger advance, almost similar amount of time to today. So what happens next, I don't know, but it'll be likely a little bit more difficult than it's been over the past 5 months. And really, if we go back to 2023, we had another long streak from March through August of last year. So it was just, we had a little bit of a correction, 10% correction from August through October last year. And then we got right back on a very smooth uptrend. And these periods, enjoy them while they last, enjoy them while they're going on, but it's not typical. Typical, you have to, as an investor, pay the price of admission for returns, which is periods of higher volatility, periods of drawdowns, periods of correction. So this type of behavior, abnormal, definitely not unprecedented, but you shouldn't expect it going forward. Hopefully, it'll be a benign scenario. We have a pullback, we have a correction, but I wouldn't expect this type of smooth sailing to just continue throughout the remainder of the year. So, if we're talking about Tesla, we have to discuss the recent delivery data. And what a lot of people were saying is, why is the price down so much? And there's a number of reasons for it. I think the big reason being valuation, but the other thing is the market moves first and then the news comes out. So the market is anticipating slower growth rate, lower growth rates. We saw that in terms of revenues, in terms of profits we've been talking about, but now we're seeing it with the actual hard data in terms of deliveries. We got the first quarter deliveries for Tesla down 8%, 8.5% year over year. That's the first year over year decline since 2020. And we haven't seen deliveries this low since 2022. So very unusual for Tesla, which has been in a period of just rapid, significant growth in terms of the number of vehicles it's delivering and selling. So unusual to see it move back a little bit. And we'll see if this is just a one-off, but they're forecasting a more difficult year, Tesla, in 2024. So if we look at the interesting divergence here from a few years ago, back in 2020 and 2021, Tesla was far and away outperforming every other, not only auto company, but every company in general. Was the number one stock in the S&P 500. And today, very different story. We have Tesla down 20% over the last year. All of these other major auto companies positive, and we have Toyota at the top here, actually up 71% over the last year, driven in large part, I'd say, by hybrid demand and the excitement over that area of the market. So Tesla moving in the opposite direction, seeing reversion to the mean, down close to 60% off of its high, and second longest drawdown now in its history since its IPO. Likely to become the longest because we're just so far below the high, and we're not going to see a Tesla in the next few months hit an all-time high unless we just saw some unbelievable spike higher. So likely to surpass this. And the lesson, of course, for investors is that when expectations are extremely high, as they were for Tesla in 2021, and valuations are extremely high, if anything goes wrong, you're talking about trading at 30 times sales, trailing 12-month sales, almost 15 times forward 1 year sales back then. That's extremely high. And when valuations are that high, if anything goes wrong, if everything isn't extremely perfect, then you're going to have this situation where things have to reprice. So things have been pretty good for Tesla, I would say, over the past few years, but not good enough. And when you have falling growth rates and you have revenues kind of flat year over year and profits coming down, that's enough to have a reversion to the mean. And so now trading at a more reasonable price to sales ratio, 6 times, still well above what something like Ford and GM is trading at, but nowhere near where it was a few years ago. And of course, investor sentiment, what's interesting about this is when Tesla was at an all-time high back in November 2021, you had just enormous exuberance for Tesla. Today, very different situation with the stock down 60% from its high. So interesting to see that change in investor behavior. But when you have a high growth company trading at a high valuation and everything doesn't go right, you have this type of repricing. Nothing unusual in terms of the history of the markets, and much more difficult, I would say, today, saying what's going to happen from here. Is Tesla going to be valued like an auto company, or is it going to be valued based on what it's going to do in the future, where it has some other type of big business driver? Market still, I would say, is assigning it a multiple that's higher, well, very much higher than if it was just in the auto manufacturing space. So market's still believing growth will come back and that Tesla will eventually morph into a technology company, more of a technology company that has higher growth and higher margins. So if we're talking about volatility, I would say you should really expect volatility to be higher for the rest of the year than it's been for the first few months. And that isn't saying much because we've had such low volatility for the first quarter. We only had 3 single days in the S&P 500 where we saw a 1% or more decline in the market. And we just got the fourth this week, but four is still very, very low. So the average year sees 29 of these types of declines throughout the year. Last year was kind of a typical year. We saw 28. The year before that, well above average, 2022 saw 63 of these types of declines. But point is, when this is extremely low, you should expect it to go up. When this is extremely high, you should expect it to come down. So we're in the period now where things have been very benign. We saw that huge uptrend in the NASDAQ 100. On a similar note here in terms of volatility, you should expect always mean reversion. When you have extremely low volatility, it's going to be followed at some point by higher volatility. And if we look at sentiment here, I just want to give an update. We talked about this the last few weeks, but another rise in terms of the percentage of investors in this investors intelligence survey that were bullish. We're up to now 62.5%. That's the highest since 2021. And very rare to see this level of bullishness. And the spread between bulls and bears in this index hit 48% this week. So just a huge spread. I had only 14% bears. So very huge spread between bulls and bears. And that's even more unusual. I think only 2% of the time it has this survey seen more extreme bullishness. So you have a lot of greed going on today. You had a lot of fear back in October 2022. And what that has meant historically on average is not necessarily the market's going to go down from here, but the average return has been below average when you have this type of extreme sentiment. So we'll see what happens over the next year, but keep your expectations in check. And when you have very few investors that are bullish, you want to be more bullish. When you have a lot of investors that are bullish, you want to be more skeptical, definitely more cautious. Probably not the time to take a lot of risk in your portfolio. So if we're looking at the volatility index here, is really a lesson of mean reversion. The average VIX is 19.5, but you're rarely at the average. Usually you're below it or you have spikes above it. We've been below it for a while now. We have last week, it was in the 12s. We had a little bit of a spike higher this week, but nothing to write home about. When the VIX gets to levels like 30 and 40, historically, that has been an area where you want to start thinking about adding more to your investments because you have a higher probability of an above average return. But when the VIX is very low, it's not really a signal. There's nothing to say that it can't stay low for a long period of time. But the overarching message here in terms of volatility, when it's extremely low, that shouldn't be your expectation. Your expectation should be, okay, this is highly unusual. There's going to be more volatility. I have to be prepared for it. I have to make sure in my portfolio I'm taking the amount of risk I can handle. So don't assume these moves, these small moves up and down are going to continue like they are today. We could have a long period of low volatility like we saw in a year like 2017, but that is highly unusual, highly abnormal. Much more likely we're going to see a correction of at least 5% at some point this year. So the most expensive short ever, I'm putting out this question here. I don't think I've ever seen anything like this. CNBC had a story about Trump media, and we talked about it last week, but this is just fascinating here. They reported a $58 million loss for 2023 in their new filing, $4 million in revenue. And we talked about the crazy price to sales ratio it was trading at. So a lot of people sent me messages saying, well, this is a short. Why not just short this? It seems clear it's going to come down. Well, a few things with short. Number one, the market could stay irrational, of course, and it could drive it into even crazier levels in the future. But the other end of short is you have to pay for borrowing those shares. So when you short sell a stock, you borrow those shares, you sell them immediately in the market, but you're making a promise to buy those shares back and then send them back the money with interest. So you're going to pay a financing cost on this Trump media of between 750% and 900%. And that's way, way higher than what you typically would pay. The average stock financing is 0.1% per year. This is 750% to 900%. So what this article is saying, to break even after 1 month, you have to see the share price drop by over $30 in that 1 month period. That certainly could happen, but if it doesn't happen, that's you're going to end up losing money even if the shares go down. And they have been going down. We've seen now a 48% decline from the peak last week, and it was trading at some crazy 2,600 times sales. Now it's under 2,000 times sales. Of course, all of these numbers are ridiculous. They're so crazy, astronomically high because the revenue is so low. But the point is, I think in terms of selling short, it's not that simple. It's a race against time. You have to not only see it go down, you have to see it go down very quickly to make up for those financing costs. And why are the financing costs so high? Well, it's simply because there seems to be very few shares available to borrow. So it's just a supply demand thing. So there must be a lot of demand from people saying, this is crazy. It likely should go down from here because it only has 1 million users. It shouldn't be a $10 billion market cap. Well, we've seen that already almost cut in half. But I think the structural issue is that you have to pay such a high financing cost that even if you were right, let's say it goes from 40 to 30 over the next year, that's not going to be enough for you to cover where that financing cost is currently. So just an interesting wrinkle in terms of shorting the market. You have to be aware of what the cost of borrow is, and that if it's extremely high, that's often prohibitive. You need to have a crash today, which could happen, but now you're making a bet not just on the stock going lower, but when it goes lower and how quickly it does so. So very interesting to see that. We'll monitor that, see if that lending cost comes down, and see if last week I was talking about this as a signal of potential froth. We're seeing that come down. Interesting to see that coincide with a little bit more volatility this week. So we'll see how this shakes out. Interesting to watch. So how to lose $1 trillion. The Fed could give a course on this. Why do I say that? Well, they've lost $1 trillion in terms of their balance sheet, which of course they don't really care about because they're not forced to sell it, but they put out this annual statement in terms of their holdings and their unrealized gains or losses. And here, just a crazy amount of losses, 585 billion on the treasury securities that they own and 363 billion on the agency and more GSE mortgage-backed securities. So just total here 948 billion, just a stunning amount. And why did the Fed why are they showing such a huge loss? How did their securities go down in value by so much? Well, simply they bought these securities at the very worst time. They bought treasury bonds and mortgage bonds when interest rates were at all-time lows. The Fed was buying trillions of these bonds. So if we look at 2020, 2021, when most of the QE was going on, and they added trillions of dollars to their balance sheet, they were buying these bonds at ultra low interest rates, and interest rates have risen from here. And the way bond math goes, if interest rates rise, the value of your bond goes down. Of course, if you hold it to maturity, which the Fed seems like they're planning on doing, they're not going to actually incur a loss. But in the interim, if they had to sell it today, if they were like Silicon Valley Bank and they had to sell it, they would incur obviously a massive loss, almost $1 trillion. It's down a little bit from last year, but still unbelievably high. So I can't think of a better reason to say that the Fed shouldn't be in the business of buying these types of securities, because they've proven that their timing is just about worst imaginable. When interest rates were at their lowest point in history, they essentially went all in on buying these securities. You can see this here in their balance sheet. Huge, massive spike, and then it continued. So it wasn't just that initial crisis. A lot of people say, well, you have to forgive the Fed. We were in a crisis. They continued to do it when the crisis was over, when the economy had recovered. They're still buying these bonds every single month. They're still buying mortgage bonds when you had interest rates below 3% on the 30-year mortgage. To me, that's inexcusable. To me, that's enough to say that the Fed should relinquish their power. Congress should say, you no longer have the right to buy these securities. You shouldn't be distorting these markets. You certainly shouldn't be allowed to buy bonds and buy mortgage bonds when they're at all-time lows and just say, I'm going to hold them for the duration of that period of time. And you shouldn't be allowed to print money in order to do this. Of course, the Fed doesn't have their own source of money, so they have to create money out of thin air to distort these markets and manipulate it. And the thinking is, well, it's good that the Fed does this, providing liquidity when they need it, but it's not just a short-term thing, as we can see here. They rush in to do it, but they don't remove it as quickly as they do it. It takes a long time. And so here we are, 1.5 trillion now. The balance sheet has been reduced, and a lot of people are saying they need to stop. They should stop reducing their balance sheet. Of course, that's ridiculous. If anything, they should reduce it faster, in my view. But April 2022 was the peak in the balance sheet, 1.5 trillion. But that doesn't erase this. We still have over $3 trillion to go. And most people are saying we're not going to get anywhere near that. The Fed's going to stop at some point this year in terms of reducing their balance sheet. We'll see what happens. But I think you can't provide a better example of why the Fed shouldn't be buying these types of bonds. They've showed that their lack of credibility in terms of being able to time these at appropriate levels. Just when you didn't need interest rates any lower, that's when they were piling on and buying more and more of these securities. So, what is the Fed doing in terms of are they making money? Or are they losing money? Well, usually the Fed, because they're printing money and they're buying bonds, you would think that that would create extra money. And usually they send that money over to the Treasury. But now, interesting situation, the Fed is actually in the hole. They lost $114 billion in 2023. And the reason for that is they're paying out more on short-term securities in terms of reserve balances and reverse repos than they're taking in on those long-term bonds. So because of the yield curve and the fact that it's inverted and the short end of the yield curve is yielding higher than the long end, well, the Fed has all of these long-term bonds that they bought in 2020, 2021 at less than 1% interest rates, and that's not bringing in enough income versus what they're paying out in terms of interest expense on these reserve balances for banks and for these reverse repos. And so 114 billion in terms of the cumulative, now we're at, as of April 3rd, 163 billion. So this is all money that the Fed at some point they'll have to make this money back. And when it goes back, then they'll remit that to the Treasury. But as of now, the Fed is essentially in the hole, and we're financing their operations until they go back into profitability. But just another example here, Fed mismanagement. They mismanaged their balance sheet worse than any bank that I could think of, to the tune of close to $1 trillion in losses. Terrible market timers, and certainly shouldn't be trusted to do this again in the future. But I don't hear anyone saying, let's take away the Fed's power. If anything, their power has been increased during this period of time because they started not only buying treasury bonds and mortgage bonds, but in my view, without congressional authority, they started buying junk bonds and investment grade bonds as well. And nobody since that point in time has told them you shouldn't have done that and you can't do that again in the future. So let's talk about June. I think it's in jeopardy here. I think we're getting more and more data saying perhaps the Fed will not cut in June, which I don't think they should, of course, but there's a lot of back and forth, different people saying different things. Powell did a speech this week saying, still the jury's out essentially, but that there should be a path to rate cuts this year. But in terms of the short term here, we're seeing gas prices go up $3.56 a gallon, highest since last October. If we look at price of crude oil, going up every week. The last 1, 2, 3, 4, 5 weeks are at $86 a barrel, up over 20% so far this year. And as we've been talking about, this had been a driver of lower inflation throughout most of last year. Now it's going to start moving in the opposite direction. And I think we're going to get a CPI print that's going to surprise some people next week. And we have ISM manufacturing prices paid. We're talking about this as a leading indicator, suggesting we're likely to see that CPI decelerate. And now we had been going sideways here, but starting to tick up a little bit here. Maybe not extreme, but certainly not indicating that we're going to see that 2% inflation rate anytime soon. So ISM manufacturing PMI, another interesting point here. We're now back into expansionary territory. So we had 16 consecutive months below 50. And that was the longest streak we saw in contractionary territory since 2000, 2001. And I'm pointing this out because we had seen a deceleration in that CPI during this period of weakness for manufacturing in the US. And if manufacturing activity is going to pick up again, that might be leading to additional price pressures as well. All we have is the short term in terms of inflation, because commodity prices can fluctuate very widely in a short period of time. So we don't know what they're going to be for April. But what I would say for March, we're going to get the inflation data next week. It's likely to come in 3.4% is what the Cleveland Fed is predicting here. And that's going to surprise a lot of people because the Fed has been saying we're making progress towards 2%. And if we look at core CPI, yeah, that's expected to fall 3.7%, but still nowhere near that 2% inflation. So the question is the Fed going to ignore those readings and focus instead on their core PCE, which the Cleveland Fed is saying it's going to continue to come down? Are they going to ignore readings of CPI that are stubbornly now remaining above 3%? I think it's going to become harder and harder for the Fed to do that. And the market seems to be more and more in line with that way of thinking. These are the odds of a rate cut in June: 53% for the 500 to 525 basis point range, and 2.5% for a 50 basis point cut, which I think definitely isn't going to happen. But we're close to 50-50, which is close to a coin flip in terms of whether this is going to happen or not. And you have increasing, I'd say, dissension in the ranks here. Raphael Bostic here, Atlanta Fed president, who's a voting member, said this week the Fed should cut its benchmark rate only once this year and closer to the end of the year. So again, market was expecting 7 coming into the year. Market's now expecting 3. Fed has been pretty consistent saying 3 rate cuts, but now here you have a member saying maybe we should only do it once and hold off here until later in the year. I would agree with this line of thinking in terms of holding off and maybe no cuts, because we haven't seen clear evidence yet of getting to that 2% target. We have still this inflation rate moving in the opposite direction, and just focusing on one indicator and looking at core PC and saying we're going to get there eventually, we're going to get that down to 2%. I don't think that's enough. And I think people are still feeling the pain of higher prices. Everything's going well in the economy. Things are going well in the stock market. The housing market is at all-time highs. What is the rush to cut in June? Why not stay higher for longer? Has been my viewpoint. And we'll see. Maybe by the time we get to that June meeting, the policymakers will be on that view again. I hope so, because I think it's the best course of action for the U.S. economy long term. So is CPI understating food inflation? I think this is an important question. Everyone keeps asking it when I tweet out charts about what the CPI is saying in terms of food prices. Everyone says, well, that's nonsense. It's understating it. Well, the Wall Street Journal actually looked at the prices of a basket of goods. These are commonly purchased goods in terms of the supermarket. And they looked at it a few years ago. They looked at it today. And we're looking at, over the last 4 years, an increase they found of 36.5%. And that translates into 8.1% per year. And if that seems high, it should seem high, because that's way higher than what we've seen for wage growth over the past 4 years, which has been about 4.9%. But importantly, it's a huge spread between what the government's reporting. The CPI from the U.S. government, 25%, they're saying, in terms of food price increases over the last 4 years. That's only 5.8% per year. So well below what the Wall Street Journal is finding. So what is the gap here? Why is the government saying 25% and Wall Street Journal 36.5%? It could be a difference in the baskets of goods, the methodology, obviously, that the government uses. But I think any way you look at it, for most people, they're thinking closer to this number than what the government is reporting. They're probably thinking prices have risen definitely more than 25% over the last year, which means that things are actually more difficult than what the government's saying. And yet another reason why the Fed should stay higher for longer, to try to not only minimize the rate of food inflation. So we've brought food inflation, according to the government, down to 1%. But why not, as I've said, bring it to negative territory for a period of time to bring that overall average price lower? So we're talking about, even if you believe the government statistics, 5.8% per year. So even that we've got back down to 1%, that doesn't erase this huge spike higher. So why not, as we saw it go negative back in 09 and negative here in 2016, 2017, and in the early 90s went negative. This isn't unprecedented. Why not have it go negative again and bring some of those prices down? I think that should be the preferred course of action from the Fed. We'll see what happens. For now, they don't seem to be saying that outright, but maybe they just have to see that data next week in order to be convinced that inflation has, the war against inflation hasn't been won just yet. So I want to end, as I always do, with something positive, and that would be rising net worth. And this is huge, of course, for every American. You want to see your household net worth going up. And what we've seen in 2023, we have final data now from the Federal Reserve. We saw a huge snapback in net worth, $5.9 trillion decline in 2022, and in 2023, $11.4 trillion advance to a new record high. Last 5 years, this number is kind of stunning. 50% increase in 5 years, just something you don't typically see in that very short period of time. 50% increase in household net worth. So we'll end it right there. Thanks everyone for watching. If you're watching this on YouTube, hit that subscribe button. Have a great weekend, everyone, and I'll see you next time on the Weekend Charts.